What's happening, Frugal Fam? My name is Mike, and you are currently watching part 4 of this series, which is based on raising your credit score. If you're new here, I just want to say welcome. I created a 4-part video series designed to give you some different ideas on how you can improve a bad credit score. So if you haven't seen those previous videos, then be sure to check them out in the link above.
Oh yeah.
But if you're all caught up, then this chart should look familiar to you. These are the different factors that affect your credit score. And based on the percentages in the chart, we can see that payment history is the most influential factor, while credit mix and new credit are the least influential factors. And up until this point, it's taken me about 3 videos just to talk about payment history, which is okay because there is a lot of good information to share within this category. But hopefully, I can talk about these 4 remaining factors today, and then we can finally be done with this video series.
Yay!
So let's start off with amounts owed. I'll tell you more about what this category means, and can give you some ideas on how to improve within this category to ultimately help increase your credit score. And I'll do the same for the remaining categories that are on this chart as well. Ready, set,
Go.
Alright, this guy we should already be familiar with from the previous videos. The basic idea here is if you don't want to have a bad credit score, then make sure to pay your bills on time. And if you want more info on that, then just check out the part 3 video of this series. And so let's move on to amounts owed. This category is basically about how much debt you have in total. So consider mortgages, student loans, auto loans, and any credit card debt you may have. These types of debt all fall within the amounts owed category and are all weighted a little bit differently. And based on how your credit score is calculated, it looks like paying down your credit card balance is gonna be more weighted than paying your monthly mortgage. And speaking of credit cards, that's a great spot to introduce the term credit utilization. So having all these different types of debts are important to your credit score, but they're not as important as your credit utilization, which is the amount of money you're spending on your credit card versus your actual credit limit. So using myself as an example, I only have one credit card, which has an $18,000 credit limit. So we're gonna plug that number into this fancy formula. And then next, we'll figure out what an ideal credit utilization rate should be. So according to Experian, which is one of the 3 major credit bureaus, they recommend keeping your credit utilization rate below 30%. So we'll plug that number into the other side of the formula. And so now if we solve the equation, we find that in order to maintain a good credit score, I need to be spending less than $5,400 per month. And one thing I want to note is your credit utilization is only for your revolving credit, aka your credit cards and line of credit. So in my example, if I was only allotted an $18,000 credit limit between 3 cards, then that means I can only spend $5,400 a month between the 3 cards, which ends up being $1,800 on each card, or just $5,400 a month on one of the 3 cards. And so now that you have a better idea of how credit utilization works, I'm going to give you 2 concrete steps you can take to help improve your credit score within this category. The first way to improve within this category is to reduce your credit card spending. Meaning that if you have a really high credit card balance, then the next time you're buying groceries or paying bills, then consider using a debit card or paying with cash. Your priority is to completely pay off your credit card balance. And if that's not a realistic goal, then you should at least try to get your credit card balance below the 30% utilization rate. That way, you'll not only be paying less in interest to your credit card company, but you'll also remain in good standing with your credit score. The second way to improve your score within the amounts owed category is to increase your credit limit. So going back to our credit utilization formula, if we left all things the same and increased my credit limit from $18,000 to $25,000, then we see that my credit utilization rate drops from 30% to 21.6%. This seems like a quick and easy way to lower your credit utilization rate. So let me show you how to do this using my bank as an example. So I have Navy Federal Credit Union, and on the section listing my credit card, all I have to do is click on the button that says increase my credit limit. And then I just have to verify some personal information and then input my annual pre-tax income and how much I'm spending on rent each month, and then it's all set. After that, I just have to wait 24 hours to see if my request to increase my credit limit has been approved. And one thing I just want to mention is requesting to increase your credit limit may not be appropriate for everyone's situation. For example, assuming that your bank approves you for a credit increase and you're being responsible with your credit card spending, then in the long run, your credit score should increase over time. However, in the short term, your credit score may temporarily go down. And that's because of something called a hard inquiry, which is the next section I'm going to discuss on this chart. So from my understanding, a hard inquiry is anytime you are giving permission to someone else to check your credit history. So with me, for example, I currently have one hard inquiry on my credit report, and that's from when I used to live in Boston and was applying to find an apartment to live in. I filled out paperwork giving the landlord permission to check my credit history because the landlord obviously wanted to make sure I was reliable and was going to pay my rent each month. Hard inquiries are not just limited to renting apartments. They can also be used anytime you are applying for a financial product. So just like a few moments ago, when I applied on my bank to increase my credit limit, yep, that was a hard inquiry. And yes, it is going to temporarily lower my credit score. So I took the hit on that for you guys, but it's not a big deal. Just do me a favor and hit the like button on this video. And based on this chart, a hard inquiry would fall under the new credit category. And as I mentioned, it will temporarily lower your credit score, but it's not the end of the world. We can see that it only accounts for 10% of your credit score, and it is not as influential as something like paying your bills on time. And the only other thing I want to mention within this section is in regards to soft inquiries. An example of a soft inquiry would be checking your credit score. So I have a question for everyone watching right now. True or false? You can check your credit score as often as you would like, and it will not affect your credit score.
Survey said.
The answer is true. Soft inquiries you can do all day, but hard inquiries like applying for a mortgage or an auto loan are going to temporarily lower your credit score. And so now that we've knocked out this category, let's take a look at the next one, which makes up the other 10% of our credit score. So your credit mix is exactly what it sounds like. It's all the different types of credit accounts that you have. We usually break this up into two categories. There's installment credit and revolving credit. An example of revolving credit would be a credit card. There's not an official end date, and you are required to make a minimum payment on the card each month. With installment credit, you can think of things like mortgages or student loans that have a fixed end date. And so having a mix of revolving and installment credit can benefit you within this category. But remember, your credit mix only accounts for 10% of your credit score, so it's not going to be that influential in changing your score. And to illustrate a real life example of how your credit mix works, I just wanted to share with you a quick story of something that happened in my life recently. So to start off, I dabble in the online dating world of Bumble. Don't judge. So anyways, I matched with this girl and she told me that she recently paid off her student loans and then noticed that her credit score dropped from an 804 to a 781. She attributed that decrease in credit score based on her credit mix and not having enough different types of credit. Now, of course, I don't know this girl's financial background, but let's just assume that she has one student loan and one credit card. And so now that she no longer has her student loan, she's left with only one form of revolving credit. And according to Experian's website, the best way to optimize her credit mix is to have a blend of both revolving and installment credit. Now, I'm not recommending that this girl needs to go out and get a mortgage. Remember, your credit mix only accounts for 10% of your credit score. But if you are watching this right now and you don't have any credit history to your name, then here are 2 suggestions to help get you started. For revolving credit, you can apply for a secured credit card, which is usually used by people who have bad credit scores or short credit histories. The basic idea here is whatever amount you deposit into the account is the amount that you will be allotted to use in credit. Meaning if you deposit $500, then you can spend up to $500 on the credit card. So that would take care of the revolving credit. For the installment credit, you could take out a small personal loan and just be sure to make the payments each month. Both the secured credit card and personal loan are examples of how you can optimize the credit mix category. And last but not least is your credit history, which represents 15% of your credit score. This is fairly straightforward. It's how long you've been using credit for. So using my landlord example from earlier, when applying for an apartment, a potential landlord wants to see that I have a history of paying my debts back on time, as this is usually a good indicator that I will be a responsible tenant and pay my rent on time each month. So an easy way to establish your credit history is to open a credit card and keep it open as long as you can, even if you don't use it. I know when I was deployed in the Navy, I was reading a lot on Dave Ramsey, and the first thing I did when I came back to the US was I cut up my credit card and then I closed my credit card account. Looking back on this, closing my credit card account was a mistake. I should have just cut up the card and left the account open. Fast forwarding to today, that would have helped benefit my credit history a lot. And so even if you're not a fan of credit cards and you don't plan on using them, I would recommend that you at least keep the accounts open. That way you benefit from having a longer credit history and having a larger amount of available credit. And so I hope you guys enjoyed this video series. If you want to watch the entire series from the beginning, then check out the playlist that's linked above. Otherwise, I hope you learned something new about credit scores and are more informed on how you can improve your credit score within each of these categories. I'll see you on the next one. And as always,
Stay Frugal, fam.
Hey guys, I just wanted to thank you for watching this video. Be sure to hit the subscribe button that's right above me. And then check out my other videos, which I'll have listed on this side of your screen. We'll see you next time, Frugal Fam.